Hi, I'm Patu from freefincal, and in this video, let's talk about fixed income options for retirement. That is, when you're planning for retirement, what are the options for you for the debt portion of the portfolio? That is the fixed income instruments. Everybody agrees that a good chunk of the portfolio should be in equity, and this can be in mutual funds or stocks or a combination of both when your retirement is at least 10, 15, 20 years away. But what are the choices for fixed income? So that's what we shall talk about in this video. But I have a couple of announcements before that. The first one is that this month's equity mutual fund screener is now available for download. This is rupees 111. You can use the link here to look at the screener, understand what are the features, and then buy it. I shall also leave the link in the description box. The other thing I want to tell you is that when you access your phone, when you go to the Google search app, or if you go to Chrome, um, you will see a discover feed. You will see a feed. You will see a selection of articles that Google gives to you specifically, and that those are articles that you are interested in, and that's called the discover feed. And in this discover feed, sometimes you might see some articles from freefincal. And if you do see such articles, my request is that you can see a little notch here in just below the title. Just push that notch upwards and say that you want to see more such articles, and then you will get more of such articles in your discover feed. So this is yet another way to catch up on freefincal articles. Of course, if you go to the freefincal page, it will ask if you want to add the freefincal icon to the home screen. You can consider adding that as well. That's just that's called a progressive web app, and that will the icon only will be added to your home screen. There will be no storage space taken away from your mobile, because the backend is simply the Chrome browser. So please do consider following articles on that. Someday you may also even see freefincal videos also on the discover feed. If you do see that, please also push that notch up. So let's get back to talking about fixed income options. Like I said, the choice for equity is clear. What are the choices for fixed income? I wrote an article about this a few days back, but I thought I'll do the video a couple of days later, because at that date was boring, so I'm going to do it today. So there are two considerations here. The first is that if your retirement is several years away, at least 10 years away, maybe more than that, you should be holding at least 60% in equity. Your portfolio should be 60% in equity. If you have just started earning, and if you just started investing, this is fairly easy to do if you are careful about how to where you're investing, and if you have control of the proportions, and if you are able to invest just about enough, you should be able to manage that 60% equity allocation. But what happens is, for many people, they start investing in equity late. Even 5 years of investing only in EPF, PPF, that kind of traditional fixed income investments, just 5 years will make it very difficult for you to make your portfolio 60%. So if your retirement is at least 10 years away, more than 10 years away, preferably more, then or maybe 15 years, preferably 15 and above, then I think your first goal should be to change your fixed income heavy portfolio. If that is the case for you, change it to 60% equity as soon as possible over the course of a month or so. Don't get worried about return sequence of the current market. Top market is at the all-time high, market is at the all-time low, recession and all that. Your need is very far away. It's better to get into the correct asset allocation as soon as possible. Go ahead and do that. The problem is, we have a bias. We like that 8% nice return that we are getting. We don't want to give that up. Unless your salary is super high, it will not be possible for you going forward to just by future investments make the equity portion 60%, leaving the fixed income assets untouched. It's very difficult to do that unless your salary is very high. You can actually do a simple projection in Excel if you will be able to do that. at about 10% increase in investment every year. My feeling is most people will not be able to pull it off, and you need to shift some corpus. Unfortunately, if most of it is trapped in EPF, then you cannot shift. If it is in PPF, then after 7 years you have liquidity, you can shift how much ever is possible gradually every year, and so on. In my case, I just talked about my new pension scheme returns. I have been trying very hard to keep my equity allocation close to 60% because my new pension scheme, the investment that I'm making grows at a rapid pace. Because with every DA it increases, with every year there's an increment, it increases, and so on and so on. So because of that, it's very difficult. But so far, I've been able to manage, and also for my so let me talk about that later. So that's the first consideration. First thing is you must have 60% equity for long-term goals. If you are debt heavy, consider shifting to 60% equity if you have at least 15 years away. Also, I talked about gradually you should reduce the equity allocation as you go closer towards retirement. That also you should keep in mind while planning. You can use my robo advisory template to plan that beforehand. That's already factored inside. You can calculate readily how to do that. So with all that said, now let's consider, let me have a look at what I wrote so that I don't miss anything. So I just wanted to say that because I was able to quickly increase my equity allocation to 60% and make sure that my NPS allocation, which is practically fixed income, does not increase too much in the portfolio, I was able to hit the financial independence mark only because of that. So it's very crucial that if you have enough time, you should increase your equity allocation as soon as possible. So that's that, and we can have a look at these. So these are traditional. This is a traditional list of fixed income options for retirement. Initially, it's okay if you're heavy in EPF, heavy in PPF, heavy in NPS. What I have been doing is, at least with my son's goal, which is also a long-term goal, what I do is I don't invest much in PPF. At least for the last, I mean, I've never done that for both retirement and for my son's goal. I have an account for it. I have never hit that 1.5 lakh mark. What I've done is whenever the equity markets gives me a big return, I rebalance and push it into PPF. Of course, by doing that, you cannot rebalance back. If the equity market drops down, you can't take from PPF if it is less than 7 years old. You can't take fully from PPF and push it back. If you can't take from EPF if you are doing it by two-way rebalancing is not possible. So what I would suggest is let your core holding of your fixed income be EPF or NPS, debt option alone, no equity in NPS, have it elsewhere. Or you can have a combination of EPF and PPF, however you are comfortable with, but stick to the overall asset allocation. Let that be a core holding. Then you can have a satellite holding, that is as you're booking profit from equity for when there's a good year, you can take that money and put it into an arbitrage fund, or you can put it into a debt fund. This will allow you to push it back into equity when there's a fall in the market. Or gradually, as you're going close to retirement, you can gradually pull out money from equity. As I said, you have to consider a stepwise decrease in equity allocation. When you do that, you can also consider putting it in an arbitrage fund or putting it in a debt fund. Of course, you have to be careful about the kind of holdings that it has got. You should be careful about credit risk and so on. I want to make this very clear. Please do not chase returns by choosing risky bank FDs because they're giving 1% more, because they're giving 0.5% more. Don't do that. Don't get into all this small finance banks. Don't get into cooperative banks. Stick to banks which are too big to fail. SBI, HDFC, ICICI kind of banks. The RBI themselves have recognized that these banks are too big to fail. And if they do fail in some kind of catastrophe, the government will jack them up and help them out in some way. So your money will be reasonably safe. So stick to, if you want fixed deposits, stick to good banks. Don't chase after risk because that is concentration risk. That is more riskier. Small finance bank FDs or cooperative bank FDs or any kind of other these payment banks FDs, whatever they call it. All these FDs are much more riskier investments than a debt mutual fund, than a credit risk in a debt mutual fund. If you are if you are careful about how to choose a debt mutual fund, for example, if you choose a debt mutual fund which has got a large AUM, then the way allocation to each bond will be less. Then you can very well take that risk. Even if the NAV falls, it will be only 1%, 2% fall, which you can stomach. It's not a big deal over the long term. It will be okay. It will all even out. So don't worry. Don't chase after risky bank FDs. Keep it in safe bank FDs. But my suggestion is that, I mean, you have basically, like I've mentioned here, there are three kind of options here. You can, if you are ultra conservative, you can stick to liquid funds, overnight funds, or maybe some ultra short term funds. But that's a kind of a overkill. I think it's see, because for a long term goal, putting a little bit of money in FDs and RDs is also bad, because every year you have to report the tax and pay the tax as per slab on that. That will kill your compounding. And liquid fund, overnight fund, very short term bond also is kind of bit of an over. It's being too conservative. I would not suggest that. You can. My suggestion is, I have shown you how my NPS, which is full of guilds, has done. It has done quite well. Without any kind of rebalancing. Of course, the fund manager would have done some rebalancing internally. That's why I've got some risk management done. But if you choose a pure guild fund, I have talked about it, like a 10-year guild fund, or you can choose a diversified guild fund. You can also consider dynamic bond funds, but some of them can take credit risk, so that's very dangerous. Better to stick to gilt funds, either diversified gilt funds or 10-year constant maturity gilt funds. But you must rebalance once a year. You must rebalance to equity, and this. If you do that, then you have good volatility protection in your portfolio. You can also consider taking a mix of credit risk and investment interest rate risk. You can buy long-term bonds, you can buy corporate bond funds or banking and PSU funds. It's not a big mistake for over the long term. See, the mistake is when you want money in 2 years and you buy a corporate bond fund or a credit risk fund. It's a terrible mistake. But if you want money after 20 years, buying a credit risk fund over that long term is all right. It's quite fine. It's not a big. So you should know when to take what risk. So these are your options. My suggestion is stay away from all risky FDs. Avoid FDs for long term. Use debt mutual funds. They are wonderful products. They're extremely tax efficient, because if you hold them beyond 3 years, you have indexation option. Even if the inflation is like 4%, the tax that you pay is 20% plus cess. Because of indexation, the effective tax will come down to about 17% or 16% if you're lucky, if the inflation is higher, and so on. So then, for those in the 30% slab and 20% slab, this can be beneficial. For those in the 5% slab, it's not. Especially those in the 30% slab, debt mutual funds are fantastic. You must explore it and not get scared about credit risk. I still maintain, if you know how to choose debt funds, the risk is significantly lower than buying a risky bank FD. So those are your options. So like I said, have a core portfolio with EPF or PPF, but don't put all your money there. Have a satellite portfolio. You can book some profit from equity and use it for rebalancing, at least partially rebalancing, and then as your retirement heads closer, you can consider putting when you book profits from equity or reduce the equity allocation. Partially you can put it in PPF because it's tax free and it's wonderful. Partially you can put it in these debt funds or arbitrage funds, however way you're comfortable. Just that you should understand the risks and be careful and keep a track on the portfolio. So those are your investment options. I have not said anything new in this. So that's the summary for you. Tax efficiency is crucial. If you want tax-free, then there will be a lock-in like PPF. Liquid instrument is essential for two-way rebalancing. You can use a liquid fund or a bond fund or a gilt fund. There is always a risk, but that risk is lower than choosing a risky bank FD. As you shift, as you go towards your retirement, you must have most of your money, at least money for immediate income. You should be in a liquid fund or overnight fund for income, but that you can worry about later. Initially, you can talk about your focus should be on rebalancing and risk reduction, but that also can wait. You can take some time to read about these instruments. I have a free ebook on debt funds. Go ahead and read it, and then you can start diversifying your fixed income portfolio. So that's what I wanted to say. Check out the mutual fund screener.